Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Taking a look at the markets this morning. The S&P 500 is down 0.2%. The Dow Jones Industrial Average down 90 basis points, almost 1%. The NASDAQ down 0.5%, and the Russell 2000 down 0.2%. So nothing is working. VIX is a little bit higher, but it's not crazy. It's a reading of 23. Gold's edging down slightly. Bitcoin down $2,800 to $71,380. 10-year Treasury sits at 4.22%. Year to date, crude's story up 70.5% at $103+ a barrel as of close yesterday. We'll take a look in just a second to see where it's at today. Silver down is up 12% year to date. Gold's up 16%. That's interesting. Silver was a little bit hotter than gold, and then it changed. Let's take a look at Brent crude's 109.57. Uh-oh. That is getting hot and heavy in price action. 109.57, up 6% today. Crude oil itself is 2.77%, sitting at 98.18. The Russell 2000's barely up for the year. The NASDAQ down 3%. The S&P 500 down 2%. The Morgan Stanley All-World Country Index is down the least, but it is down. European stocks are getting hit pretty good compared to the United States. Again, year to date, it's only March, and a lot like last year, we had the Trump tariff tirade, if you will. This Iranian war, I keep reading about it, and I'm like, when's this going to go away? They've taken out a lot of top people in Iran. I don't have the political depth to tell you what it all means or what the plan is. Micron is riding their memory price spike into the earnings tonight. Stock's up 62%. The AI trade of NVIDIA, which really had no competition in the large language model space, is expanding. And Micron is one of the people who can have more upside in the next year than, say, NVIDIA, in my opinion. Micron's expected to report a 148% revenue growth for the February quarter as average selling prices surged 32% quarter over quarter. Would I play it for the long-term investment? Probably not. More of a trade. The memory provider's stock has soared thanks to a shortage brought on by heavy demand for NVIDIA's artificial intelligence chips. That's caused memory prices for things in PCs and smartphones to predict shipment declines. It's that much of a spike. Micron's market cap is now $520 billion, passing Oracle, which is now $445. It's amongst the 10 most valuable U.S. tech companies. It used to be a boring commodity maker. That's what's fascinating about Micron. I'd say, look at your PC right now or your laptop or your phone and tell me what type of memory is inside of it. Tell me the company makes. I knew Micron because they make pretty good gaming memory modules. Amazon and Google, which buy large quantities of NVIDIA chips and rent them out through cloud services, they've been ratcheting up their forecast for capital expenditures. Cloud providers need racks full of NVIDIA's Vera Rubin graphics processing units in their data centers, and each system requires large amounts of memory. For instance, the NVIDIA Vera Rubin NVL72 system uses roughly 3 times the dynamic random access memory, also known as DRAM, as the Grace Blackwell GB300 rack did. A single Rubin Ultra graphics processing unit will have a terabyte of high-performance HBM high-bandwidth memory 4E, more than 3 times that of one Rubin GPU. At NVIDIA's GTC conference, Taiwan Shea, chairman of the parent of Micron rival SK Hynix, said the memory shortage will continue for another 4 or 5 years. That stinks. It means we're going to be paying more for our phones, more for our computers, more for our laptops, more for our AI data centers. Stockpiling of GPUs has sent memory prices for other products ripping higher. PC DRAM contract prices surged significantly this quarter. RBC wrote that blended DRAM pricing is set to jump 80 to 85% in the first quarter. It's now expected that sales of personal computers will fall. IDC lowered their forecast for PC sales, expecting a decline of 11.3% this year compared with the firm's November estimate of 2.4% drop. Memory shortages will persist well into 2027. Dell has warned of the spike in memory costs, with operating chief Jeff Clarke telling analysts on the company's February earnings call that the cost of DRAM has climbed 5.5 times in the past 6 months. Clarke said, "We're working with our memory partners to be as flexible and as agile as possible. We're working through things of how do we minimize our complexity? How do we improve our mix?" Micron is taking steps to increase supply, but some of that build is ways off. Doing a groundbreaking ceremony means you're a couple years from being able to make the memory. They just recently broke ground on a place in upstate New York, one of 4 future fabrication plants. The Iran war is producing the sharpest spike in gas prices, gasoline, since Hurricane Katrina. The average national gas price jumped 5 cents to $3.84 today, highest since September of 2023. Front month gasoline futures are trading about 2% shy of their 2026 peak. Prediction markets are implying that gas prices will end the month near but below $4.30 a gallon. Prices are up nearly 29% over the past 20 days. It's the sharpest such rise in fuel costs in more than 2 decades. Hurricane Katrina, which made landfall in the United States back in August of 2005, was one of the deadliest and costliest natural disasters in American history. The damage wreaked havoc on the energy infrastructure in the region, prompting gas prices to jump above $3 a gallon by early September, from $2.30 in early August. Do you remember Hurricane Katrina? There are some crazy documentaries made about Hurricane Katrina. Oklo is up today as analysts are spotlighting permits progress. So yesterday we reported on this. It's a $61 stock, ticker symbol is OKLO. It very well could be one of the most important stocks for AI as an investment, in large part because it's nuclear power. Now, do you know the finances of nuclear power? It's a whole different industry than DRAM semiconductors. The nuclear power startup for progress in securing key government permits and approvals. Oklo advanced its momentum with the Department of Energy approval, so said Barclays. Price target's $82. Keep in mind, it is currently a $61 stock. And if things go right for them, they're going to have years of building small modular reactors, SMRs. And that's going to help the AI industry get away from coal, natural gas, and oil. Despite strong execution reaction, Citi said they may skew negative given higher than anticipated fourth quarter operating expenditures. So they have a price target of $73. They have a high risk rating on the stock. Barclays has an overweight. Needham has a $73 target. Their analyst said the company did not disclose their Aurora unit costs. 2026 capital expenditures are expected to be in the $350 to $450 million range, above expectations. They're lowering their price target from $135 to $73. They're maintaining a buy rating. They don't think they're going to get a lot of gigawatt up and going until 2035. 3 gigawatts is when they're expecting 2035 of nuclear energy. Doesn't 2035 sound like a long way off? That's the play on AI at this point in time, is energy, memory, DRAM, storage, copper versus optic. DocuSign sealed the deal. They had a good quarter. $2 billion buyback shows investor confidence. They delivered a solid quarter highlighted by a steady execution and encouraging forward guidance, particularly around ARR growth and margins. The continued traction of its IAM platform is central to the long-term story as it expands DocuSign's beyond its legacy e-signature roots into more comprehensive agreement management ecosystem. Some early adoption trends already generating over $350 million in annual run rate revenue, suggesting it's resonating with customers and helping drive bookings and retention improvements. Strong balance sheet, stepped up buybacks, management signaling confidence. Starbucks is in the news today. RBC's Logan Reich commented, when we assumed coverage in November 24 at an outperform, a key aspect of our thesis was relatively small temporary investments were required to turn around the U.S. business. That did not materialize, giving ongoing labor and additional future investments, which makes it tougher to justify the outperform. So we moved to the sidelines. They're talking about Starbucks. Key points to our downgrade is permanent labor investments plus net cost savings over the next 3 years are smaller than we previously anticipated, implying further investments required. Improvements to the U.S. top-line growth are well appreciated, and the stock is trading near peak historical multiples. I have a Pints and Portfolio coming up April 18th, Saturday, 11:30 to 1:30 in Sunnyvale, California. It's a good chance for you to meet with Ryan and Julie, who are two CFPs. It's ideal for people who are 50 plus heading towards retirement. I'll buy a beer. We'll talk financial planning issues, retirement issues, questions you may have. Take a look at what you're doing right, take a look at what you're doing wrong, and mainly just be social and network. You can sign up for the event at robblackshow.com.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Joining me now, Patrick O'Hare with Briefing.com, a source that I use every morning when I start looking at the markets, a source that I use at the end of the week when I'm wrapping things up with the big picture. Patrick O'Hare, I am always entertained by the stock market, but this year seems even more surprises, twists, and turns. What are you making of the year so far as we are halfway through March already?
Good morning, Rob. Yeah, it's been all in all, I'd say it's been a good year, but
That's
of course we've had a geopolitical event throw a wrench into things, and what we've got going on now with oil prices has prompted the market to really question the fundamental outlook. Prior to this war, there was a more resolute belief that you'd see very strong earnings growth, above potential economic growth, inflation moderating, the Fed cutting rates, right? And that's all been upset now by the recent events. And so you have a market in the moment is rethinking the fundamental outlook, and so it's getting a little more risk averse here in the near term, certainly, because the uncertainty factor has absolutely been ratcheted up.
And just like you said, though, the market has been quite resilient based on earnings, kept inflation, and things not getting too far out of hand. The inflation numbers that came out this morning were a little bit alarming. When my phone blurted them out to me, I was like, uh-oh, what's that all about?
Yeah. Yeah, at the wholesale level, we saw some higher than expected inflation prints for the month of February. And perhaps the concerning factor for the market this morning was that it wasn't just centered around goods, it was also seen in services. But the other element here that the market is taking into account is that this inflation in February occurred before the subsequent rise in oil prices we got when the Iran war started. You already had kind of a disarming print here for February, and now the market is likely to believe that things could look worse when we get the March data out. It will look worse. You saw Treasury yields react to that. They went higher. Saw the equity futures market reverse and move lower. And you've got a market that's now struggling here to find some upside traction because, again, it's another factor that's forcing market participants to question the fundamental outlook, and in particular, what the Fed will do with its policy path. And of course, we have the Fed out today, but the PPI data we got this morning didn't help the cause for anyone who was looking for a rate cut sooner rather than later.
It sounds like a ridiculous question, so please note it's coming. The Fed's going to cut interest rates when Warsh gets in. We think Warsh is going to get in. We're going to see probably, according to his statements, 75 basis points, 3 cuts of 25, maybe all at once. Is it that simple? Is it we're going to get a rally at the end of the year from the rate cuts? Question mark.
Yeah, I don't think it will be that simple because it's a committee. He has one voice, okay, one vote. Now, his voice might resonate more because that's the one people will be paying attention to, but he has a really tough job if things stay where they are, convincing other committee members to cut rates. I think the one thing that he would have going for him in that regard is if there was a rapid deterioration in the labor market that coincided with what we're seeing here with inflation, because Mr. Warsh will probably be of the mindset that this is a transitory inflation factor, right, as it relates to energy prices. And the question is, can he swing other committee members to believing the same, or will they fall back on just being cautious-minded and waiting for more time and data to pass before they come around to cutting rates? Mr. Warsh seems to think there's room to do. It does, again, raise the element of uncertainty, and you've seen in the Fed funds futures market, even market participants are pushing things back themselves in terms of when they think there might even be a rate cut. It's now out to October, the October meeting when the market thinks you'll get the likely next rate cut, and not that long ago, that was going to be seen sometime in the second quarter. So if we keep getting bad inflation data, we're going to see that expectation continue to get pushed out because the market will be of the mindset that the Fed's not going to move in the face of inflation that seems to be taking off.
What are you taking a look at that you're surprised with right now? I'm surprised oil is above 85, above 90, and it's not affecting the market. I know that the United States isn't as reliant on oil as we used to be from other countries, but I am surprised the market's just holding steady so far, and to me, it feels like it's going to crack at some point and all the water's going to come out and ruin a good market.
Yeah, I'm paying attention to really this inflation factor, frankly. Okay. It's not just about oil. You hear reports of chemical companies raising their prices. Saw today, I think Alibaba and Baidu raising their cloud prices. You saw, I think the memory makers are all charging more because there's some insatiable demand for their product. And that's it's going to have to bleed through at some point here. And I think that the inflation risk might be underappreciated at this point, and that's something to pay attention to. So I've got that on my mind right now, and because that filters through to other areas in terms of what it could do to interest rates, and it should drive interest rates higher, which could then weigh heavily on growth. And so you get into that situation of perhaps you get into a stagflation environment. And just a reminder, there's three components to that. There's low growth, there's high inflation, but there's also rising unemployment. Paying close attention to the inflation factor and how that can bleed into another of other things, such as higher interest rates, which could then in turn weigh heavily on growth. And so you get into a potential situation where you have a stagflation environment. And there's three components to that. It's not just high inflation and low growth. It's also rising unemployment. And to this point, we have not had a real market jump in unemployment. The unemployment rate's still relatively low, but to get those three factors, it really puts the Fed between a rock and a hard place in terms of knowing what to do with respect to its policy path. And a stagflation environment just isn't good for the stock market or for most things in general.
In all of your readings and research that you do, I'm assuming it's quite numerous like mine, how are you feeling about AI and the effect on your job in the sense of trying to read an economy? Because we're now starting to see some companies let go of employees that may or may not be tied towards the use of AI. It may just be right sizing after the pandemic. Are you finding anything statistically important or too soon to tell?
I think it's too soon to tell. You can see AI is clearly getting smarter and more reactive, and the inference factor is going to be important here. But that's also the launch of AI agents. I was reading an article this morning that ServiceNow CEO is suggesting that college grad unemployment could go as high as 30% because the proliferation of these AI agent workforces handle the skills that normally would have been attended to by entry-level workers. And so that's really concerning when you hear someone who has a front seat to this talk of such things. But as of yet, we haven't seen that real dislocation, but certainly a worry out there for a lot of knowledge-based workers and certainly for a lot of college students right now looking at ahead at the job market and their job prospects.
Thanks very much. It's Patrick O'Hare with Briefing.com, a reliable source of domestic and international news that you can use. I start my day with them. I end my week with Briefing.com. I'm Rob Black.
This interview featured on The Rob Black Show is brought to you by EP Wealth. Learn more at robblack.com.
Had some technical difficulties today with Patrick O'Hare, but I think you got the gist of most of what he was trying to say. Crude oil is the story right now. This war is not playing out exactly like the last one did. Over the years, the United States has become oil independent. That's one of the reasons why. But today's reading on the producer price index, the Federal Reserve would probably be talking about raising interest rates, even though we know there's going to be a management change with Jerome Powell and Kevin Warsh. Warsh has said, I'm committed to cutting 75 basis points, which is where I think we should be in the conversation, not even on future plans. Taking a look at the S&P 500, it's down 0.5%. The Dow is down 84 basis points, a little bit better than it was an hour ago. Same thing with the NASDAQ. There's not enough there for me to really dig in and say it's a bad day. Trump has waived a U.S. shipping law in a bid to lower gasoline prices, issuing a temporary waiver on what's called the Jones Act, making the transport of seaborne cargo around the U.S. cheaper as the administration attempts to combat the domestic effects of quickly surging energy prices. How long is oil going to stay high? I can tell you it's already affecting spring breakers. And spring breakers are you and me. They're the people who run the economy. Spring break, I'm surprised to learn this. It's actually March 1 through April 30th in the travel industry. So it's 2 months long. Airlines project a record 171 million passengers are going to fly over the spring break. That's up 4% from 2025. And yet, we have TSA staffings down. Airfares have spiked. 21-day advance purchase fares jumped. Transcontinental flights across the country more than doubled. Caribbean flights up 57%. Florida up 42%. Transatlantic flights increased 39%. Airfares are rising as jet fuel is about 25 to 30% of their expenses. Gasoline's not going to be a reprieve. 75% of spring breakers will choose to drive. Gasoline has jumped from $2.87 a gallon to $3.67 a gallon. That's the biggest and fastest jump since Hurricane Katrina. This is interesting news. Meta is shutting down the virtual reality social platform Horizon Worlds in a further pivot away from the metaverse. Meta is shutting down Horizon World. The platform, originally designed for Quest VR headsets, will still be available on the mobile app. The announcement comes as Meta scales back its once prominent metaverse focus to prioritize artificial intelligence. It was ridiculous. And Mark Zuckerberg, just not very likable. He's one of those people that I cringe when I see him. I don't know why that is. The shift for Horizon Worlds was once a central part of the company's push into virtual reality. Comes after Meta cut over 1,000 employees from Reality Labs, the unit that was responsible for the metaverse. Billions and billions of dollars went into this project. Horizon Worlds struggled to find users as the general public remained skeptical of virtual reality. I got a Quest Pro maybe 2 years ago. And it was okay. You could see where the technology's going. It was uncomfortable to wear. It was ridiculous. That's the problem, is if it's going to be a social device, you have to be in two different areas, which is fine because my kids are usually in two different areas from their friends. But it's not going to catch on for many years until the form factor gets much smaller. Apple found that out as well with their virtual reality headset. I saw one person in the wild. I was dropping a kid off at a soccer game, and he had the Apple virtual reality headset on. And I was just like, that looks ridiculous. And he was in his car, like maybe sleeping and watching a movie. I know the world is moving more towards solo experiences. So maybe if I were, back in my 20s in New York, I'd have one by my bed so I can watch entertainment at night. But I don't know. It doesn't. Let's move back into my world. NVIDIA CEO Jensen Huang says OpenClaw is definitely the next ChatGPT. NVIDIA is building security around the technology with NemoClaw to enable safe and scalable adoption of AI agents. It's now the largest, most popular, most successful open source project in the history of humanity, Jensen said. OpenClaw is an open source autonomous AI agent platform that goes beyond traditional chatbots. Instead of answering questions, these agents can complete tasks, make decisions, and take actions with minimal input from users. The AI chip leader NVIDIA announced NemoClaw, an enterprise-grade version of OpenClaw that layers NVIDIA's software stack and tools on top of the platform. The goal is to make those powerful AI agents secure, scalable, and ready for real-world use. I would expect that in the next 6 to 12 months, more people are going to have AI agents that work for us. A lot of the research that I do could probably be skimmed by my agent. Watch me do it for a few days, get the idea, give me the final 20-page report, and I'll use that for my daily shows. Anthropic already integrates beautifully with email. So if you have too big of an email database, you can start using Claude to get control of it, if you will, and tell you what to task. I don't know when my kid's spring break's going to be, but that's something my AI agent can find out for me on his terms. Go to their school sites, see who gets the whole week off, who gets part of the week off. See if I've booked any plans, see if they've booked any plans. It's coming. What's interesting is AI or NVIDIA now has become a boring value stock. It remains in a range of about 175 to 190 since last summer. They plan to return 50% of its free cash flow to shareholders, totaling over $85 billion in 2026. Forward PE of just 21 times. NVIDIA is cheap compared with Apple, which trades at over 28 times earnings. Apple has an advantage because they have 2.5 billion devices that use their operating system. Not all of them will be AI ready, but many of them will. And inferencing is going to be done on a local level. That's the plan Apple has for security reasons. Value stocks typically trade at lower than average PEs to the market, and that's where NVIDIA is right now. So NVIDIA is in a good place. You're going to have to buy back a lot of shares. And it's not a hyper-growth company. Hyper-growth companies use their revenue to grow. So I'd call it a growth company now. And yes, I do expect it to go to 250, maybe in the next year, based on market conditions. That's not a big move. It's got a big PE right now. It's something we all have to be very honest with. Did I say big PE? I meant to say a big valuation, market cap. Over $4 trillion. Chinese tech giants are rallying after hiking AI prices. ADRs of Alibaba and Baidu are gaining today after the Chinese tech giants announced AI price hikes. Alibaba said it's hiking the price of its AI chips by up to 34% and raising the cost of cloud storage by 30%. Baidu is planning on increasing AI cloud product prices by up to 30%. These Chinese tech companies are trying to show the United States that AI is not just a technological breakthrough, but a core tool for money making. Baidu's decision to raise prices on its AI cloud products by as much as 30%. It's positive development. AI is moving towards monetization versus price competition. Gemini space station stock crashed after its IPO. The city thinks it could fall even further. You do not see people say this out loud very often. Ticker symbol is GEMI. It's had a rough run since going public last September. Citi downgraded the stock to sell from neutral. They think Gemini is years away from profitability. Citi argued, and it's struggling to compete in a depressed crypto market. Gemini stock is down 17% in early trading. It's declined 28% on the year. It's the crypto company that it's not a space company yet. Maybe one day, but it was started by Cameron and Tyler Winklevoss, two twins that dress like each other that helped start Facebook or were around when Facebook was started. They've been big Bitcoin. They've been on Bitcoin since Bitcoin was a baby. Gemini went public at $28 a share. Had a broad sell-off in October. It's now down around 40% from its heights. Monthly unique visitors to Gemini app and website have trended down since September. App downloads totaled 41,000 in February, down more than 100,000 each of the previous 9 months. They've been increasing concerns that the company will be challenged to scale profitability. Some other stocks in the news today: Macy's up 5%. Department store chain reported earnings that were stronger than anticipated. Same-store sales at locations open for more than a year were up 1.8%. There's not enough money for me to find Macy's as an investment. Jabil declined 7.7% today. The data center infrastructure company posted adjusted earnings that topped expectations. Revenue easily beat. It's been on a big run. Lumentum up another 12%. The optical networking company and NVIDIA partners said it expects to reach a quarterly revenue run rate of $1.25 billion within the next 9 to 12 months. I talked a lot about Lumentum and optical stocks yesterday on the afternoon podcast. Typically, my third segment in the afternoon podcast is very tech heavy. For those of you who want to cheat and go there first. Morgan Stanley turns bullish on Tesla, sees robotaxi scaling as key catalyst for demand and cash flow growth. A lot of competition in robotaxis now. Andrew Percoco offered Tesla's ability to scale the unsupervised robotaxi fleet is the most important catalyst for the stock this year. Each incremental mile driven by the robotaxi fleet accelerates learning for personal full self-driving, which supports higher full self-driving attach rates and re-accelerates auto demand, improving free cash flow generation. I don't see it. It feels to me that Tesla had its heyday already in the past when there was generous tax credits by the United States government. Morgan Stanley said, "We had the pleasure of hosting Tesla at our conference in San Francisco, followed by a Giga Texas tour. Coming out of these discussions, we are incrementally more positive on the outlook for robotaxi, particularly its progress in addressing edge cases around pickup and drop-off. They believe a successful robotaxi rollout has potential to create a powerful flywheel across Tesla's ecosystem. Incremental unsupervised robotaxi miles driven improve the underlying autonomy model, which accelerates the path to personal unsupervised full self-driving. This in turn supports higher full self-driving attach rates." A lot of things that we keep hearing. I just want to see the robotaxis without drivers in Austin or whatever city it needs to be in. Because right now there's a lot of safety monitoring those rides. Optic stocks, I just talked about having a great run right now. Applied Opto Electronics, ticker symbol AAOI. Lumentum, ticker symbol LITE. And Coherent, ticker symbol COHR. They're rising on signs that their products are in high demand as artificial intelligence infrastructure continues to expand. I've said this for a couple days. I'm just trying to message very loudly. I own shares of NVIDIA. I do not expect it to do what it did in the last 3 years. I expect it to be more of a growth stock. And hopefully in the future, a growth and income stock. It's not there yet, but it's starting to be valued like one. The yield on NVIDIA is 0.02%. It's tiny. They're giving away essentially 4 pennies, a penny per quarter. It's ridiculous. It seems too little, doesn't it? For a stock that's $181. The K-shaped buffer is helping Delta soar above airline industry's fuel price woes. Delta seems like the play if you're going to do one on the airline, because they just pursue premium passengers. They get 60% of the profits in the industry, in the airline industry, go to Delta. You can find me online at robblackshow.com. It's robblackshow.com. I got to get ready for the afternoon podcast. Stick around, tell friends. Don't forget I have a Pints and Portfolio coming up in the peninsula. Sunnyvale, California, 11:30 to 1:30. Sign up at robblackshow.com. It's robblackshow.com.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.